Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon, everyone. Hopefully you guys have had a wonderful April 5th. It was definitely a quad 4 type environment out there today, otherwise known as payday for us in Hedgeye Nation. So we'll get going here on Weekly Notebook Review in just a second. We'll let folks kind of trickle in and get sorted. Thank you, everyone, for taking the time to listen in and be part of this conversation. Hopefully it's, you're continuing to find it a valuable source of information each week. For those that may be new or have just kind of found a Weekly Notebook Review, these happen every Wednesday at 4:30. This is the time where we review our weekend work and what's transpired midweek. So things that may have changed or signals that have gotten weaker or stronger, items on the inside the notebook that have been circled and recircled or starred and highlighted, and how that may influence our portfolio allocation, our portfolio construction going into the end of this week, next month, next quarter, the rest of Q2 here, et cetera, et cetera. So should be another great conversation today. We got lots to talk about. The big takeaway is obviously, get short and get paid. That's certainly what's happened today. The market wasn't even down that, quote unquote, that much. But certainly, not that we have a lot of feelings around here, but we certainly felt like things were a lot worse than they really may have been on paper here. So, this is, I had a call earlier this afternoon, and the big takeaway, and we've said this a number of times on this call and across other channels here at Hedgeye, is that recession risk is rising, and the earnings, it could be that big catalyst. Now, is that a sure thing? Is that going to be across the board? Who knows? Time will tell. Certainly the Foxconn data that came out yesterday or early this morning / last night certainly would lead you to believe that some things like maybe Apple earnings might not be quite as robust as one might imagine. But at the same time, that's not really, we're not really here to speculate. We certainly take all the data into consideration and then act accordingly and let that influence where we go and how we position our portfolios and how we, how we express these potential outcomes. And the, you got to remember that we are in the chop bucket. I tweeted this out earlier today, and we're squarely still in chop. VIX is at 19.09. Vixen's at 24.62. The RVX, the Russell Vol, is at 25.76. These are where things have closed on my screen, at least at around 4:34 on a Wednesday afternoon. And all of that is still squarely in the chop bucket. In fact, VIX just, really it's under 19. So it's still very much on the low end of that chop bucket. You saw Keith in Hedgeye was very active in regards to covering some shorts, and I'll say it again. It was payday. Keith walked by my desk going into the studio around 11:15 or so, and he just kind of mumbled to himself, "It's payday, baby." So just want to reiterate that. And again, this is I'm going to say it again. This is the chop bucket. So as much as one might feel all excellent and wonderful for being on the right side of the trade or having your shorts work, you also got to move that inventory. Keith said that multiple times today. He did go, he basically closed out all of his longs, which one could argue BTAL is really an anti-beta play, so really kind of like short the S&P 500, and then the other one was the dollar. So he closed out of the dollar, and so currently on the board there's no longs out there on the portfolio, but he was adding to shorts going into the close, and knocking down some inventory like the exposure on the real estate side of the portfolio. So again, it's you gotta pivot, rotate, press those shorts or wherever those opportunities are. perhaps at the top end of the risk range. One of the things that I was looking at going into the close was certainly energy, whether that was through XLE or XOP. Those were certainly caught my interest. Going to be very curious to see what Keith has to say about those in the morning, because again, I think we all generally understand the energy exposure and the demand slowing there. But he didn't go to the wood on energy names yesterday. Now, granted, he has a lot of energy exposure on there inside of real time alerts, whether that be through call it general energy exposures or factors like United Arab Emirates, that kind of thing. Or he also has small caps energy on the board still. So there's definitely factors exposure there. And likely if he was sitting in this room or on this call with us right now, he'd probably would have said just wasn't quite at the top of the range. But if you execute there, you're doing the right thing. And I would probably agree with that. I did not pull the trigger on any energy. I added some yesterday and kind of just let it ride out. Kind of kicked myself. I didn't cover a little bit and then reshorted into the close here. But hey, we're going to see how things play out tomorrow, and maybe we'll get another opportunity on that front. So energy certainly is sticking out on the page, and in regards to some pivots that have occurred from the weekend work to midweek. Obviously had the OPEC kind of announcement happen on Sunday late afternoon, evening, and that's influenced sort of that trade here this week. But still very much bearish trend, and again pushing up. Let me see, where did that close actually? CL closed right around 80.3. Well, it's not really closed yet, but 80.38. So top of the risk range is still a little bit higher than that, almost at 82 there on the WTI. So again, these are the industrials, the late cycle earnings. These are all things that are really big themes in my mind. And I'm actually sitting down with Jay Van Sciver tomorrow for Sector Ed Spotlight. Really timely and obviously topical conversation with him. But again, these are kind of these big themes, and I see Chris Moyer out there, my boy Thousand Air FX. He's talked about this. A number of other people have alluded to the same thing, is in terms of what worked last year might not work this year, whether that be in particular he's talked about the dollar and how it was an outperformer last year. Certainly gold is being that outperformer and that lead horse so far year to date. But again, we have to kind of in this choppy environment, I think just pivoting and following the signal and being diligent with your process and building out that side of the equation is really crucial. So we'll kind of leave it there. I see I'm going to actually invite both Chris and other side Mitchell up here to talk, and then we can keep on rolling. So energy certainly standing out. Duration is again another big theme. The gold exposure, another big theme for us. These things have been working. Don't chase gold up at the top of the risk range. But yeah, we'll go. Did that not? Hey boys, does it not work? I invited you up here. Maybe you can't talk. Maybe you're just in listen only mode, which is totally cool. So I'll just keep on going. Oh, there you go. Chris. Maybe I just didn't hit the button the first time around. How you doing, Chris?
Yeah, I'm good, mate. How are you?
Good. School holidays going on in the UK, right?
Yeah, we literally just got back from watching the new Mario movie.
Oh, cool.
Yeah, so
How was that?
it's quite good actually.
Yeah.
Yeah,
That's
it's
awesome.
fun, like spotting. I'm a pretty big nerd, so like spotting little bits from old games and stuff popping up. It's like I was just as bad as the kids. It's like, oh look, there's a Duck Hunt sign.
That's amazing. You are a nerd, but a nerd that I love dearly. Mitchell,
Thanks, man.
other
Yeah,
side,
buddy.
you're getting shout outs left and right, man.
It's yeah. I'm not I'm not very important. That's a promise.
Yeah. Well, don't tell that to anybody here at Hedgeye. We think very
I
highly of
thought
you, Mr.
I
Kraus.
thought I thought it was kind of funny. I literally walked. I don't go out to eat every day. I mean, what the past handful. It literally seems as if I go out every day. But Monday happened to. My wife had the kid had my other daughter out for some reason. So Emmy's gymnastics are 16 hours a week. So we were on our own, and I walked into Texas Roadhouse, and I'm just like, this is just too good. And I'm like, Howard's not going to want to hear from me every time I go out to dinner. But the place was literally 75-80% empty. And the woman looks at me and she says, name please. And I said, oh, no, my daughter and I just table for two. She goes, yeah, that'll be about a 30-minute wait. And I looked at her with my mouth like nearly to the floor. And I scanned the entire restaurant. And I said, there is no one here. And she goes, yeah, it'll be a 30-minute wait. And I just went, don't worry about it. We're good. And we just walked out. But I couldn't believe it. I was dumbfounded.
That's great.
Rate of change, deceleration, slowing.
Yes, absolutely.
So as the counterpoint, we go to the cinema quite a lot. And maybe it's just the movie, maybe it's just the one that we went to see, but I've never seen our cinema as busy since, God, for like 2-3 years.
Well,
tonight it was just packed. Like a lot of the time there was maybe, God, not even 50%, God, not even 25%. So you can just pick your seat, sit wherever you want. Whereas tonight it was like whichever seat you booked, that's where you're sitting, because it's just there's no gaps.
Well,
like it could have just been the movie.
I think you got the movie, and I don't know what it's like over there, but here it is spring break, right? So you got kids all over the place, and our kids were on spring break for 2.5 weeks.
Holy.
And exactly. My wife and I love the children. We're both working, and we wanted to tear our eyeballs out. The first week we had help from my wife's mother. She flew down, but the second week into Monday, Tuesday of this week was just, we're working. My little one must have come. I can't tell you how many times my little one came downstairs and I just looked at her and I said, sweetheart, I unless it's like really, really important, like really, really. And the next time she would come down, I looked at her, I'm like, is it really important? Like, really, really? And she just turned around. So, all right. But notebooks.
Notebook, yeah. It's really,
notebooks.
really, really important.
Yeah. Past handful of days, definitely quad 4 days. I don't want to say everything quad 4 was working, but you had commodities down, you had even gold, throughout the end part of the day for me, or not for me, but gold for a period of time did go up. It was positive even after the massive run up. Obviously it closed down small, but it closed down much less than what it was throughout the course of the day. And you had, oil closed down. Your shorts on high yield were working. Shorts on Microsoft and Amazon were working. Shorts on IWM working. I mean, HCA has been a bear. It's been a crushing bull. I mean, HCA's just been on a tear lately. Bonds. So you got healthcare side of the book working. You got bonds working. Dollar working. So it was a quad.
Yeah, I mean the long short, like traditional quad 4 basket was up about 100 basis points on a combined basis today. So it definitely, that was a significant outperformer. Quad 3 was probably the closest at around a kind of like 87-ish percent positive return. So, but both quad 1 and quad 2 actually absolutely smoked. And your quad 2 long short basket was down minus 1.45%. So again, I'm talking about like kind of general exposures. So things like long tech, long industrials, long consumer discretionary, momentum, high beta, Qs, incorporating some of the FX in, so like long your Canada, FXC. But anyway, yeah. So I mean, you're spot on. Right?
And if we look at current, like if you go around the horn and you look at currencies, I mean, Euro USD. what were the ranges this morning, right? Range was 1068 to 1094, and it closed previous at 1094. I mean, if that's not the top end of the range, I'm not quite sure what is. So I know, Keith doesn't signal on everything at all times, but if he's buying dollars at a certain period of time, you kind of have to extrapolate and do some of the work yourself and figure out where you're going to be otherwise. Now, I know Keith was short this morning. He said he was short Canadian and was it Australian?
Aussie dollar.
Aussie? Yeah. So, I mean, but at the same time, the Euro USD was nice. And then if you're doing it incrementally, you're booking some gains on a 1% move, on a currency, on a daily currency, right?
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Hope you're enjoying our podcast. Start generating alpha with our suite of Sector Pro investing research products. Dive deep into retail, industrials, technology, and everything in between with exclusive access to the sharpest analysts and actionable ideas on Wall Street. Go to hedgeye.com/research to subscribe. Enjoy the rest of this episode.
Yeah, we can keep with the currency because I actually got because this really is a broader question and something that I was going to pose to the group later on, but we can just get into it now. This is a cover someday, right? And but at the same time, some of these levels, it does look like we're kind of there's potential here that we cascade further down, right? And that basically we get, continue. It's not even oversold. It's just, basically the momentum to the downside kind of picks up.
You have VIX at 19. It's still pretty low.
No, that's my point, right? Yeah, I mean, across the board, you've got, volatility. Even, the MOVE index, closed at 153. So it was up 4%, but it doesn't matter. The point is, how I'll just pose it to you guys, and we can keep it currency related because I think the dollar, Keith covered the dollar here today, or not covered, excuse me, sold some of his dollar exposure late in the afternoon. But if we have a pullback, we're going to be adding back that pretty quickly. So my question is, how do you guys typically handle kind of a situation like this where you're getting, you want to pay yourself and get a little payday here, but then what transpired in terms of that next move? And just keep it general. We don't have to get into specific positions, all that kind of stuff, but just kind of curious.
Well, I could speak from what I did. You and I were talking Friday into the close, and
yep,
we were kind of on the Discord, not really talking to each other because we were both getting shorter into the close, right? So I kind of took off a little bit of what I put on then in a handful of those names. I trimmed some dollar position, but at the same time, while Keith was trimming the dollar position, I think it's still his second or third largest holding in his long only account, right? So it's not like is it his top outside of the?
Yeah, I mean maybe not after the sell this afternoon, but it goes UUP then BNDD.
Right. So, it's not like it's not still up there, right? So I think my dollar position is still a 5% position. And then what I trimmed a little bit of gold. I trimmed a little bit of duration at 25, 50 basis points here and there. They're still my largest holdings. And I did take a dabble with KWeb and Taiwan at my minimums. So I didn't.
Yep.
From a cash position, I'm pretty much still the same. But from a complexion of the account position, I just rearranged a few things.
Yeah, I like that. And basically, you're playing like the dollar through in a different manner, right? Because
right.
Chris has shared this many times on here, but those foreign ETFs, there is an underlying currency play in there as well. And so, for those listening in, if you didn't know that, you got to understand that there's a dollar component there where you're buying a USD ETF, but they're trading many, most of the securities in those portfolios are listed in a different foreign currency on a different exchange. So there's an FX component there. So, but Chris, how are you thinking? Again, it doesn't have to be, let's just keep it currencies for right now in terms of, and we don't have to get into your specific positions because that's not really, I prefer to kind of think about it more about how you handle something where it's moving off of, say, like a bottom end of the range, and either adding more to it, or kind of paying yourself, that kind of thing?
Yeah, it's kind of hard because
I know. Put your hat back on from like 2 years ago, all right? Or like a year ago, when he didn't turn into like a CTA.
Yeah. So, like anything, like people like take for example, like the arena in a minute. Okay, there's a reason why Keith does stuff. Of course there is, but on any it could be anything, right? It's moved off of the top end or the low end of the range, so pay is like it's a payday. Pay yourself some, right? That's fine, but it could be anything. Like it's anything and everything. It's like if the two standard deviation move for the dollar is 0.5%, and today it's moved 0.5%, then you take some off because it's already moved what it's kind of, a large daily move. But yeah, I've always talked about cadence and talked about it like dominoes. And this is kind of where I'm saying this because it's what's screwed me up in the past. So I took the piss a little bit on the arena and said that nobody's talking about gold, which, if you didn't get in too early on some of your equity shorts, maybe you would have had the space to have got bigger in the gold long. So it's all about cadence. Like there's just this tick 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 as you're slowly moving through. That if you're deciding to sell some, okay, cash is a position. That's fine. Cash is a position. It's a decision. But if you're taking some off of your, I don't know, your gold long today, like what is it you're going to buy? Is it your decision that you're going to put it into cash, or are you going to go and buy something else that you want to be long or short of, and it's up or down, so it's at the top or the low end of the range? Like it's the dominoes that happen, and sometimes people, and because I have done it in the past, still do. If you don't get the dominoes right, it can really screw yourself up for the next steps. So it's super important to get all these things right. Yeah, like I said, because you can get yourself down a rabbit hole and screw up like your next 10 trades because you didn't get one right. But there's plenty of reasons why you take, it's really hard to get winning trades. So why wouldn't you, like Keith always says, sell some. So like, why wouldn't you? It's so hard, especially if it's to the downside, if it's shorting something that happens so rarely, whatever the bullshit thing that everyone says, oh, the market's up 80% of the time. Well, if you get a short right, then you should pay yourself, because it very rarely happens.
Yes. No, that's an excellent commentary, and one you did take a little bit of the piss on the arena. It did make me chuckle, but I know it didn't.
It didn't go down very well.
It didn't.
It was funny. It was very funny.
I don't know if it came across very well to all the subscribers, but the point is really, the point you're trying to make on the arena, and for those that haven't,
just don't get the sarcasm from across the pond.
Exactly.
I know, Mitchell. It did take you a while, Mitchell.
But I love it now, Chris. I love it now.
But I mean, the point is we don't have to get into that post, but there's something that you said at the very beginning of your comment there, which was about the standard deviation move in the dollar, right? And so understanding these components, and I believe I mentioned this on a notebook review either 2 weeks ago or maybe 3, and it's and really I learned this from Chris, who read it in an article or a video, and he sent it to me recently, so I've gotten a little bit deeper into it. But basically, it's the rule of 16 on the VIX. So the rule of 16 on the VIX is at VIX 16, a 1% move in either direction is basically, Chris, that's like one standard deviation, correct? Now I'm questioning what I read. You're on mute, mate.
Yeah, so it's 1% move. So if the VIX is at
1%
16,
move is that's a 1 standard deviation move, though, right?
no, it's not standard deviation. It's just
Oh,
1%.
it's just one. It's just percentage points.
Yeah.
Okay, perfect. So it's VIX. We'll just keep going with that. So VIX. So understanding kind of these components, where at VIX 16, a 1% move is basically a general rule of thumb. At VIX 32, 2%. So these are kind of the general, general dynamics there. That if you're getting a 1%, sorry, go ahead.
It's generally implied that for long periods of time, the VIX and the S&P are inversely correlated, but that doesn't mean it's always. So at VIX 16, the S&P could go up or down 1%.
Correct.
Just as at VIX 32, it could go up or down 2%.
Correct.
It's a rule of thumb. That's a rule of thumb.
Correct. Big time rule of thumb. But kind of knowing some of these rules of thumbs or where the standard deviations are, and therefore a 1 or 2 standard deviation move, let alone a 3 standard deviation move, where you're getting kind of big tail type events, then having a general grasp of where those are and what those look like does help in terms of like executing in regards to selling some. And then the flip side of that is, and Keith and we here at Hedgeye have said this a number of times in terms of it's very challenging to ignore your cost basis, but ignoring your cost basis will serve you well because you are just acting in terms of what the signal is telling you and where these moves or when they're happening and how they're happening versus where you entered the position. So I think having those two things in play, and that really piggybacks off of what you were speaking to, Chris, in terms of like where you come into the story or where you lay your first domino. It's a really critical piece to the puzzle because going off of Mitchell's commentary on Friday, I was layering into some like Q puts and XLK puts and that kind of thing, but that was a late Friday or kind of a late morning trade, and then more late in the afternoon. If I just waited to the afternoon, I would have gotten even better pricing. So today I was kind of covering selling to close some of those put exposures, and that ended up doing pretty well, right? Somewhere between kind of 20 to 50% returns. I'll take that. But at the same time, if you were laying those in on Wednesday or Thursday last week, you might be more of like a break even on those options trades. Now, again, don't necessarily go straight to options. I'm just talking about this generally speaking, everyone here on this call. But it's a different rule of thumb, and you may not want to cover just at like break even, but that's certainly what the signal was telling us today. And I think that's just a really important part of driving that piece home. All right, so Mitchell, let's run through what else you got in your notebook. What was standing out to you? Let's go back a couple days. What was standing out to you in your notebook over the weekend, out of curiosity, in terms of some of the things coming into this week? And we don't often kind of talk about like the weekend work, right? And sort of like the prep going into the week, but maybe we kind of flip things a little bit. It's a shortened week. We're basically, Friday's a holiday here in the US. It's Good Friday. So market's closed. And yeah, so why don't we maybe go a little bit, turn it a little bit around here and talk a little bit kind of coming into the week and then now how we've, what we're trying to pivot and adjust to going into next week.
Well, if we're looking going into the weekend, what I tend to do is so on the investing ideas, ETF pros, long, shorts, etc., I tend to circle things that are awfully close to the top ends or bottom ends of their ranges relative to where they closed. Like I try to take a look at things and see what the up downs are on those, and on just as an example on investing ideas, INVH was damn near close to the top end of its range. MPW, PEB, Tesla, Revolve, EPR, ONEW, STLD, STLD, ABR, and Deere. They literally were all, so I guess which ones were not, like, well, even CPT was. So the only one that really was in the middle of its range was HZO on the short side. So as I'm kind of looking at that and I'm looking at all the shorts on the list, I mean, HYG was at 75.55 versus a high end of the risk range in ETF Pro of 75.95 with a downside to 72.16. So if you looked at the vast majority of things, they were all damn near close to the top ends of their ranges. And when things start to get that lopsided, you should all be paying attention. Also, the move, if I'm not mistaken, was down 21.73% week over week. It closed down to 135.936, down 376 day over day, but down 21.73 week over week. So I was paying attention to also on the month on the 1 month momentum. You still had a handful of negative 1 month momentum. So while some things were picking up daily and 3 week, you still had XLF, XLI, XLB, XLE, XLRE, IWM, and Pink were all still negative on a 1 month basis. So the trend was still intact from a downside perspective, in my not an opinion, but it was still intact. Though you had a ton of things pushing against the top end of the range, which kind of, I don't know, a lot of the guys that I talked to, a buddy of mine he texted me, he's like, well, how do you keep calm? I'm like, well, I'm not always right with the shit that I do, clearly. But at the same time, he asked me how I stay calm. I'm like, well, the notebook, right? So what were you looking at? Am I off?
No.
Am I completely different from what things you're looking at, or are we
Not at
similar?
all. Not at all. Not at all. Yeah, absolutely. I mean, the only thing I'd layer on top of that in terms of the ETF Pro and investing ideas, I certainly track like where the range, like the higher low, lower highs. So I thought it was a lot. We're putting in basically higher lows and higher highs. But to your point, it was, if you then cross-reference that with the closing price, it was almost, most were kind of right at like pretty close to the top end of the risk range. So really that high. So this is where it kind of becomes a little bit nuanced in terms of understanding how the risk ranges work, which are dynamic and their price, volume, and volatility. So when a big piece of the puzzle price moves higher, that just naturally moves the range higher. So sometimes, that so you kind of got to just kind of understand. And for me coming into the week, it was, okay, you saw the higher highs, a lot of the higher lows, but then there's things that are putting in lower lows too, like Kuwait or PSP, on the short side. You also had, EDV was actually putting in a lower low and a lower high. So, probably just a little bit of the move there, or kind of like volatility in that space. And the dollar too was a lower low and a lower high. So again, just kind of interesting components there. But generally speaking, yeah, I mean, I was coming into the week kind of seeing how things, making moves on the Friday, and then kind of seeing how Monday was playing out. So I actually was relatively quiet on Monday, in terms of just I kind of was more so just waiting and watching. But yesterday was where I took some action.
And also over the weekend, while daily and 1 week or 3 week price momentum on like VVIX, VIXN, RVX was negative. On a 1 month, you still had VVIX up 15.27, VIX was still positive, RVX was still positive by 7%. Russell was still down on a 1 month. Natural gas and WTI, pre-OPEC, were down on a 1 month. So, I set up based upon that, and then I did not do anything with oil on Monday, yesterday, into the close, as it was still up. I shorted a little bit more, and I still have room, but I wanted to get kind of the knee jerk shock, and it didn't. It stayed below trend, and you got most of the craziness out of the way. So I'm still with Jonesy on his thought, or his statement, which I believe is factual, where after these knee jerk reactions, they're typically a fade in a scenario like this, especially in a quad four scenario, especially as the data starts to come out and you have ISM services. These numbers are just bombs. So the more these come out, the more quad four reiterates. So even though OPEC is trying to get the price higher, the cycle is demand destruction. And I think Keith said it the other day. I mean, whether he said it or not, it's the Fed panicking, Treasury kind of
Yeah.
panicking, OPEC kind of panicking. This is all stuff that happens in what a Hedgeye quad four is, or I'm learning, over the past couple of years what a Hedgeye quad four is, or a deflationary, disinflationary investing environment. So demand destruction is part of this, and they're going to try to do what they can to centrally plan or manipulate to keep things higher, but at the usually the cycle wins unless they come with a bazooka that's so big that it postpones it, right? So
Mm-hmm.
the cycle was winning until they threw $7 trillion at it, right? That in a couple months ago, in one of my notes, I can't remember who the gentleman was, but he was talking about a quiet QE of sorts, and he was talking about a couple hundred billion here and there. And my point was more so, we're looking at trillions upon trillions of debt that's out there. We're looking at trillions of dollars. The couple hundred billion here and there, I don't think matters outside of some knee-jerk reactions. I mean, obviously it matters, but it's chump change, relatively speaking. Each one of these cycles that you have exponentially more debt added onto, because the answer is always more debt, right? Now you just have more debt at obnoxiously high interest rates, or the obnoxiously high interest rates that still have to be repriced, right? Which nobody can really do right now, or so few deals are getting done right now. So, I can't think of the number off the top of my head, but we talked about it a couple of weeks ago, 2+ trillion, 2.4 trillion of debt that has to be repriced between now and the end of next year. I mean, I think every CEO under the sun is trying to prolong that as long as they can to see if interest rates do come down, whether the Fed breaks or doesn't break. But if the Fed stays high throughout the course of the year, or they don't cut, it's just think about, and we've talked about this before, and I use it as an example often, but think about what happened to Toys R Us in 2018 when they tried to reprice their, it's 2017, late 2017, I think, going into 2018, when they tried to reprice their debt and they couldn't get it done. Obviously the company went bankrupt, and the stock, or the bonds, went from 96 to 22 in 36 hours, right? When these guys can't get this done, and none of them can get it done because the rates are just too high and it's not economical for them, then you have that credit event that Keith keeps talking about, or we keep talking about. It's just, it's not good. It's not good. Not good is an understatement of the year.
Yeah, exactly right. I mean, again, the data or the prices don't lie, and if you look at crude, WTI, CL on the futures, 1 week plus 10.28% today, 1 month positive 101 basis points, 3 months 9.23, but then you go to year to date flat, 1 year minus 21.08. 3 year though 183.95. So again, we've come from a tail duration standpoint, which we often don't talk about, but from tail duration, where we're 183% higher than where we were 3 years ago, which is a big number. But then this is where it is interesting, because this is where the dislocation with the equities can come into play, where on a 1 month basis we are still down 8 basis points on the XLE and up 5.36% on the 1 week. But then as we go back out in time, we're still again, it's just keeping there is a difference between the commodity and obviously the equities themselves, and they're even with energy up today, a little over 1.5%. They do look different than they did not rebound as much as say the underlying commodity did with the OPEC news, et cetera, which is another telling component of demand slowing and what is likely being priced in with recession or earnings recession risk rising. Hi, Pokey, welcome to the show.
Thank you, gentlemen. Hey, I just wanted to build upon what Mitchell was talking about with what you saw over the weekend. In addition to the actual ranges, one of the things that I really watch is the range of the range and how wide or how narrow is it, right? So we're we're right about now with if you go back to January 1st, that's pretty much like the trend period, right? The last 60 days. If you go back to last Wednesday, the 29th, and I'm just using this as an example, I know it's not the market, but the range of the S&P was 153 points wide. That's one of the lowest readings we've had over the last, the prior 60 days. Before that, there were a couple of days that were really lower. And then you come into Monday morning with the new risk range, and that got up to 233 bips wide. That's a 60-point swing in 3 days. I think that's one of the things that, especially to build upon what Chris was saying within the arena, people don't really, they still think of, and I shouldn't say they still think, people think of the range as this static thing, as like Keith was saying this morning, the range is always moving. And it's important to know how and understand how the range is moving relative to itself.
Yeah, awesome point. Awesome point. So, Pokey, as we've come into midweek here, what have you kind of seen in terms of like pivots from your weekend work?
Yeah, I'm with you. I had some puts on last week, and I put some more on the last 2 days. I covered all my short-term puts today. I had a couple IWMs for tomorrow and for Monday, and I was up nicely in them, and I just said, take the money and run. As Chris likes to say, you have to pay yourself. So that's kind of, I took a lot of risk off. I actually got a little long, some Qs and IWM puts for tomorrow. I think we might see like a really low volume bounce tomorrow morning. So I'm gambling a little there. But no, everything you said before, I think is spot on. I think we could cascade down from here. We could kind of hang out here. I think that if you read, Tier 1's note this morning, I think that they're basically of the camp where we're gonna tread some water here. So I think we get into next week, and next week's all about bank earnings, right? And then you get into OPEX, and then you get into month-end rebalancing. Then you're into May, and as JD was saying on the, I'm sorry, not JD, as they were talking this morning, when Congress comes back for this debt ceiling, as Steiner likes to say, the S&P dropped 15% the 2 months beforehand, so it's gonna be a wild couple weeks. So I tightened up today.
To go along with what Pokey's saying, and narrative or not, this is a Jewish holiday, and it is a short week, and volume will dry. So I don't know. When volume dries up, we tend to see, I'm not saying it will happen, but when volume dries up, you tend to see the passive bid kind of take over with less people to sell into. But that's just something for people to keep in mind. Just keep it in the back of your head. Don't trade off of it.
Yeah, and if you look at it, no, totally, and don't do what I'm doing. I'm not good at this. But I took like 2 pot shots, right? One with the IWM, one with Qs for some covered calls for tomorrow. But if you look at Apple the past 2 days, like Apple's volume yesterday, I think was the lowest for the last 60 days. And Mango, all these new acronyms that we're using, the volume is garbage on them for the past couple of days. It's going to be garbage today, and it's going to be worse tomorrow. no one is coming in to bid these. People, they bid them up, and they're going to have to sell them at some point.
Yeah, absolutely. And with that, I was going to actually open it up to anybody listening in to see if you had any commentary or questions. And then Arthur popped up. So, Arthur, it's like you read my mind.
Hey, how's everybody doing?
I'm good. It's been a minute.
Good.
How you doing?
I'm good.
Yeah.
I sent that tweet out that you liked Robert on Friday. I was shorting the shit out of everything.
Yeah, I can't.
And then you
always
go
come,
into the
I
weekend. You talk
I
about the
can't.
weekend notebook.
Yeah, I mean,
What?
I can't always come out anymore, right, from a compliance
Yeah.
standpoint and share that. But it's what I was seeing too. It's what I was seeing too.
But it's really
And
it's so ironic. So I mean, sitting here this weekend, watching the college playoffs and this, that, and the other, getting hot, getting all revved up for the Masters. But I mean, the sentiment this weekend, because of Friday, busting out, we're breaking out, everything. I mean, I fade that every freaking time, and I think it's paid. It's paid this week. But the kind of the point I wanted to make, or what I'm looking at, is this 2-year went neutral today. I think that's a telltale for me. I watched that pretty close and where the curves are. And so, the probability of maybe we're going to get our first employment report on Friday and the market's closed, that's going to be a stinker, you know? And so that's kind of what's influencing my trade this week. And I'm keeping a little bit, more on than I typically would. We'll see what tomorrow brings me. About lighten up a little bit more, but I did close out. We went down to minimums on IWM, HYG, XLK. What else I got? XLY. I did sell a little gold today. I mean, just you got to after the kind of move, and I'm hoping that we'll get another chance at building that position back up. Friday also was my smallest position. I left the day with the dollar, so I'd gotten down to about 4 or 5% on the dollar. So I'm built a little bit of that up, and then Keith put right back out of it today. So that's all right. That's more of a core position, but I think the 2-year. I don't know what people are thinking about the employment report on Friday, and I know you never know, and it's kind of a one-off, and it's pretty volatile. But the 2-year's got to be signaling something. Anyway, that's what I've been thinking and doing.
Hi, I'm Keith McCullough, and I wanted to introduce you to my favorite product at Hedgeye, the Macro Show. Why is it my favorite product? Well, it's my show. I do that every morning. If you want to get ready for the market day, you want to contextualize all the data, you want to make good decisions, then this is what you should be watching. It's a repeatable process that you can deliberately study, measuring and mapping time series to time series of data. So it's not going headline to headline and getting whipped around. It's actually being so much more dispassionate about it and making good decisions that are data driven. So we'd love to have you on our team. Come join us.
Tune in weekdays at 9 a.m. Eastern and on demand anytime. Go to hedgeye.com/research to subscribe.
yeah, the 2 years good call out. We actually haven't talked that much about yields yet, global yields. But that's a really good call out, and pushing right up against 379. Pushing right up against that kind of most recent 1 month and convert, and also 3-month low. So that was right. What was that level? That was 3.775. So yeah, good call out. Really good call out. Who knows what? Yeah, who knows what's getting priced in them, and who knows what the Fed's going to do. But certainly the market is kind of pricing back in a bit of a rate cut here at these levels.
Yeah, the market. I mean, I don't know how people feel about this, but I mean, if you look through history, the Fed follows the market eventually. They do. The market's leading here. And if you look at the curves, you look at the euro dollar spreads, CDS spreads. I mean, the ISM, these reports that have been coming out lately. Oh my God. I mean, they're terrible. I mean, they're just really, they're terrible. And so, if they get another 25 in, which they will, I guess, I think, and I'm really not that confident about it, but if they get another 25 in my opinion, my humble opinion, non-professional giving advice opinion, is is they're done. They are so done. And they're going to be cutting. And when they start a cut cycle, oh my God, you guys, cut. They're going to cut there's no liquidity out there, and the curves are uninverting, I guess. I don't know if that's a word, but they're kind of uninverting, and that's the inversion signals that something that could happen that's bad. When they start to uninvert, that's when it really starts to happen. And so that's kind of the way I'm thinking about my macro and my positions. So for what that's worth.
Yeah, no, it's absolutely, man. And month over month, that yield curve is up 58 basis points. So been a huge move. We were down at basically around -1% about a month ago, and now we're hovering around just under minus 50 basis points. So closed at minus 0.48, or it's not really closed yet, but minus 0.48. So again, this is really critical time, and I think you've hit the nail on the head here in terms of what we're seeing, and you're seeing in global yields as well in regards to what happened overnight in the Japanese 10-year, the German 10-year, which I don't think got a lot of airtime, but that was down over about 2.66%. So that was down about 6 basis points back down, not quite at its 1 month low, but pushing back down towards that level. Even with even in the UK, it was kind of flat day over day, but it's peeled back a little bit too in the last sort of week or so. So it's hovering right around 3.4, 3.418 to be specific. So again, it's going to be very interesting to see how this all plays out. And Keith and we at Hedgeye, we've said this a number of times ever since our Q2 macro themes presentation a week ago, is that if the Fed does cut, then that means this environment and the recession risk that is rising will be more like a rocket ship, because that it just means things are way worse than we even thought. And
yeah, history proves, if you look at the markets, Robert, when the Fed starts to cut, a lot of people out there that are new to this. There's a lot of new people, that's kind of COVID got into this over the, I've been in it for 30 years. But when they start to cut, people think, oh, the Fed's cutting, buy stocks. Well, you might get a little, jerk reaction, but that's when the shit just starts to, equities just start to, cascade. They'll just crash.
Yeah. Arthur, we put a chart up, I think last week and the week before, about the declines that have taken place after the Fed has started to cut. I don't know if you saw it last week or if we can find it this week. I'll try to take a look in a few minutes. But you're absolutely right. The markets get absolutely impaled once the Fed does start to cut. The market finally wakes up to say, oh, we are in deep shit.
Yeah, and then let's throw a little debt ceiling controversy from this goofy government we've got in the midst of all of that too. I don't know about timing. That's the hardest. This whole game, it's about, Keith always says it. It's the particular time. It's not about what, or why. It's when, and that's we all know that on this call. It's really getting your timing right, and that's really, really important. So. Yeah, I think I saw that, but I appreciate it. You could post that in the nest maybe again. I could take a look at it, but yeah, I think that's where I'm at. So good talking to you guys.
Absolutely, Arthur. Thank you. Thanks for jumping up. But so if there's anybody else out there who's got any questions or wants to kind of review things, I think we've covered a lot today. Chris, is there anything on your docket that we may have not necessarily missed, but just haven't reviewed? We just talked fixed income. We kind of talked about FX. The pound turned bullish. The pound turned bullish yesterday. Bullish trend. Just, I'm sure you saw that, but that was a new thing that got circled. Certainly looked like it was turning that way, where it was coming into the weekend neutral, and it obviously is, continued to kind of move higher. But I thought that was just from FX land, something of interest.
I don't know if like the Mexican dollar looks like it's made a lower high. Mexican peso, sorry, not the Mexican dollar. The peso. Yeah, it's really about just like where we've just spoken about fixed income. Is about this now. It's this whole game of I think we spoke about it not last week, the week before, whenever I was last time. It's about this rate of change between the rates differentials between the different countries. So, people have perhaps been pulling their hair out on the dollar that it's not really doing anything, or well, it is doing something that's going down until today. But
yeah,
there's been big moves everywhere else, and not necessarily in US crosses. So there's been big moves everywhere else, like whatever, like the euro against the yen, or the pound against the euro, or whatever. It's the other crosses. I've been speaking about this for a few weeks. There is stuff to be done in FX space that doesn't really involve the dollar.
Completely. And if I don't know if you saw it over the weekend, but the consensus positioning was long Mexican peso, short the Canadian dollar. So again, typically, again, for those listening in, if when you see a kind of consensus positioning, doesn't mean that we want to take the other side or that we need to be on the other side. It's just something to be of to make yourself aware, because if they, to your point, Chris, if this Mexican peso does need to be kind of unwound, or the momentum starts to move lower, these moves can kind of cascade upon themselves, because you've got a consensus long position that folks are trying to kind of peel back, right, or at least kind of lighten their load a little bit in terms of what they have exposure on.
Yeah, and it doesn't. You have to No, you don't have to understand. You have the ability to understand. Like the actors within the space, like obviously when you're talking about US equities, the overriding factor is this whole passive and what's the funds that time when you're going to retire.
I'm going to throw this one to other side, because he used to love quoting this. And
target
date. Yeah.
But you don't have that in commodity futures and FX. You don't have that, so you have to understand who you're playing with. So when you're playing in FX and futures, something like the 2-year that obviously broke down on the back of the banking crisis, what exacerbated that was it was a massive consensus long for all the CTAs. So as soon as it triggered, it didn't matter. Like for all the CTAs that were short, short end rates, not just the 2-year, but all everywhere, it didn't matter. Like the fact that there was a banking crisis meant nothing. It was just a number on a spreadsheet that said, right, I have to close that position now because it's gone below this level. That was it, and they had to close it. So in these things, all these other the consensus positions, it's not like things are kind of kept buoyant, where you kind of have this, exactly what's going on in the S&P 500 with the big, magma with those. You don't have that in other places that unwind. You have to understand who you're playing in any particular asset, who you're playing the game against, because it's not the same everywhere you go. You can't just transpose your actions from one, trading the S&P, to trading the euro dollar or whatever, because there's different people playing in. There's different people playing in that basket.
It's kind of funny when Keith talks about, there is no centrally planned such and such with, this stock or that name or this currency or that country. The three of us, we chatted about oil, and I found that oil was, until OPEC came in, oil was sticking much more closely to the ranges than some of the stuff that is centrally planned. I mean, you just, to Chris's point, you have to know who's playing the game and who you're playing against.
Yeah, exactly. And who's more likely to be, who's more likely to be the buyer or seller at given points? Like, is it whatever? Is it we're getting to month end and is it target date funds? Is it a CTA level that's going to get triggered in whatever, heat in oil or something, whatever it is? There's, like I said, it's just different understanding who is playing in that and who is the bully, who's the person or the strategy that's going to bully the price given price moves or end of month or whatever it is. There's going to be a different bully in each in each playing court.
Yeah, exactly. And yeah, because the other on the commodity front, the other one, consensus net long is the cocoa, and yet then they're short the corn and short the what's HE again? Lean hogs. Yeah, short lean hogs. Yeah, that one's not it. Yeah. So it's definitely interesting. I don't know what's lean hogs done. Yeah, so continued downward pressure. Lean hogs. That's a nice looking short right there, versus corn, which again kind of put in a new 1 month high, but failed as Keith alluded to this morning. Both corn and copper failed at trend, and perhaps that was a little bit that momentum move, what have you, some short covering happening. Same thing with the in the Canadian dollar. You saw a move kind of to the top of the risk range, and so just definitely things to be conscientious about. The other one, just FYI, I don't know, what's called the South African rand is also a consensus short position. So again, just wanting to put that out there as well, just for those listening in, which I thought was interesting. But anyway, cool. Well,
what about Japan?
Yeah. Do you want me? I didn't write that one down, so it was not. I can look it up. Do you want me to look it up real fast?
Yeah. What's the Nikkei?
Let me find it. Give me 30 seconds. Sunday. Let me filibuster here. Sunday. Find my email from Richie. CFTC. Here we go, baby. So you want the yen or the Nikkei?
The Nikkei.
The Nikkei. The Nikkei is so they're net short, but really it's nothing. They're 0.61 times on a 1 year and 0.49 times on a 3 year on the Z score. They're net short almost 2,000 contracts, and that was they added slightly week over week, but really nothing. They're pretty much flat on the Nikkei. So not a huge move there. Just the only one that was so the VIX they're they're short, but it's a net positive 1 year Z score, so they're less short, right? They covered a bunch actually this week, covered over almost 7,500 contracts, and then this past week, and then the other call out is the that I had written down. Sorry, was the 30-day Fed funds. So they are short that bad boy as well, which is and they added to that. They pressed that last week a lot.
Just on the VIX, just in terms of the levels, just to remember that although Tier 1 in their morning letter they show the curve. I'm not sure if that's the short-term curve or the actual VIX curve, but you can go on TradingView and use VIX 9D. To give you a shorter term VIX, because on the spike on the whole banking crisis and everything, that whereas the VIX kind of peaked out at 27, the 9-day peaked at 31 and it's down at just around 17 now. So you have to remember that a lot of these short-term moves, obviously now that zero DTE is a much bigger factor, you can't really use you can't run around pulling your hair out about short-term moves and zero DTE manipulation while quoting the VIX, because they're not looking at the same thing.
Correct.
It's just something to bear in mind.
Yep.
They just want to close out. We talked a little bit about oil. Uh, it's in backwardation right now, almost all the way through the curve, except for just the front end. There's a little contango. So I know you guys we're looking at oil, and what we think about oil, but I think that helps that future prices look to be lower. And I wouldn't doubt if we see OPEC cut again, just to keep that in mind. But I mean, if this thing plays out and we get into the kind of global economy that we're thinking about, and they want to keep their prices up there, the backwardation saying they could cut again at premium prices right now.
I mean,
just as a point.
I mean, these guys have to build these crazy long glass walls in the desert and stuff, don't they? So they need to they need to keep their revenues up.
Yeah.
That was quintessential Chris across the pond humor right there. That was top show.
Anyway, no one had mentioned the oil curve, so I thought I'd just throw it in
Yeah,
there.
no, it was a good call out.
If they're
Yeah,
not.
no, the contango. Yeah, no, that's a really good call out. And the other thing too, here again, if you go back and look at the CFTC, positioning. This is obviously now over a week old because it gets its positions as of Tuesday. So it gets reported
Tuesdays
on Friday.
Yep.
So we'll get new data in a couple of days from yesterday. So it will be interesting to see kind of what kind of moves happen. But consensus is actually net short across the board in terms of like equities. So short S&P, VIX, Russell, Dow Jones, NASDAQ, and the Nikkei in terms of what's reported here on the page. Varying degrees in terms of like importance, right? So S&P is a negative 0.96 times on a 1-year Z-score, but a negative 1.46 times on a 3-year. So looking at both durations, it can be helpful and influential there. So just keep that in mind.
What's oil say on that, Robert?
Last week, but wasn't a big call out. At least, again, typically you want to see, things that I look for that we look for is stuff that's kind of creeping up on 2 times in terms of the Z-score. So, or getting certainly north of 1.5, which is why I wrote down VIX. Pokey, were you going to jump in on something, or is that Arthur?
Oh, I can look it up myself. I was wondering what
cool.
the CFTC was on oil.
Yeah.
So it was. What was that again?
So the crude oil was plus 210,000 contracts, like 771. They added to it,
long.
so it's net. So they're net long, but less long than usual. So they're net long, but it's a negative 1.74 times on a 1-year Z-score, and negative 2 on a 3-year, 2.01.
Wow, you look at twos, that's where you want it to kind of get to, right?
Exactly. So they added. Yeah. So they added again. So they added. So it was even. So they're not net short, but it was like a lot less long the week before.
I get it. Yeah.
So they added to that week over week, but still a pretty decent number. So it'll be interesting to see where that. I suspect they'll add to it more this week, given what transpired. So it'll be so that number is likely going to keep going down. But this is sort of that spot from an execution standpoint where perhaps
the setup is getting better and better.
Correct.
Okay, thanks, Robert.
Yeah. Setup's definitely getting better and better. Yeah, just that trend line from Keith yesterday is 82.70. Now that line does move; it is dynamic, but that was what I wrote down yesterday on crude. So that's on WTI on crude oil WTI. CO would be the futures contract. 82.70 is that trend level. So still well above. So again, the way that I kind of cross-reference that is 82.70, and top of the risk range is 81.90. So you get that top of the risk range, below trend, with demand, demand falling, and
I'll throw one more. I'll throw one more at you. Implied discount.
Yeah, no, exactly, and that's where
it's one of the only ones got a discount. I know it's almost 0 or 1 or 2. I don't know what it is today, but it was it was a discount.
Yeah, so XLE though is an interesting one. XLE was -6 on an eyeball discount, negative 1.2 times on a 1-year trailing 12 months basis. So that was squared, which means it's got my interest on the short side. which is one reason why I kind of almost went to it at the end of the close. But that's going to be on certainly a short list, likely tomorrow, and that I suspect that discount's going to probably look even better with the move that it had today. And so definitely, these things are setting up nicely. Similarly on XOP, you can see a similar thing there too. The UUP though on the long side, it was a plus 14% eyeball premium, but interestingly enough, that does typically run a premium. So similar to kind of the crude commentary there, where they're net long but like less long. That was actually a negative 0.9 times on a trailing 12 months. So even though it's positive, buying some calls there could would have been a nice thing to do yesterday, but I did not do that. Tim, the other reason why I like energy short is because of your commentary last week, my friend. And so
that's why I jumped up. I just want to remind everybody the shittiest of oil betas or energy betas is OIH, is all your little service companies that are out here bleeding to death because gas is worth all.
Hi, Robert McGroarty here, Director of Subscriber Development at Hedgeye. Join our entire research analyst team live before the market opens for deep dive investing analysis, our favorite stock ideas, and our risk manager in chief, Keith McCullough's macro overlay. Our team of 40 plus equity analysts discuss key market developments, trends, and our high conviction long and short investing ideas. You will not get this granular level of insight anywhere else. A video replay, audio version, and analyst summary notes from the call are available shortly after each live show to ensure you don't miss anything. Go to hedgeye.com/research to subscribe. And tune in live to the call weekdays at 7:45 a.m. Eastern. Enjoy the rest of this episode.
Oh, did he cut out for everybody or just me?
Yeah, no, he cut out.
He cut out.
Yeah, so go listen. He had much better connection last week, so go listen. Hey Tim, I think you're in the we're losing connection with you, bud. But I'll just tell folks to go listen to our notebook review from last week, where you really ran down the give a very good synopsis as to what's transpiring in the gas world out there, and oil services is the way that you would play that. Yep. You're back now. If you want to.
Yeah. Sorry about that. Somebody tried to dial me while we were talking, but yeah, I was just going to point out OIH had great signal strength kind of toward the end of last week. It was a great opportunity if you were in it to reload it on Monday, and it continues to behave like it ought to behave, just based on the fundamentals. But the signal seems to agree with the fundamentals, which is always nice. So that and then you guys have talked around correlation a little bit already, but I'll just point out that the thing that got me kind of excited today was, for the first time in a while, at least intraday, we got the dollar moving inverse to equities, which was nice to get that kind of full quad 4 kind of motion going back in the ocean. So with that, I'll stop.
Yeah, great call out, Tim. On a 15-day basis, SPX negative 0.69, CRB, so commodity index, negative 0.80, gold negative 0.78, inversely correlated to the US dollar. So again, really good call out, and it's we're seeing that on a near-term basis, which again, with dollar strength, if that continues to play out, could have inverse correlation to commodities in general, which again makes sense in the quad 4 environment. All right, so we're going on like an hour and 15. Anybody out in the crowd, if you guys wanted to jump up, go right ahead. I think we've covered pretty much everything on my hit list. Maybe the only thing we haven't talked about really today is China, and call it emerging markets, but specifically China. We are back to long China. We added K-Web to the Mucker family office yesterday, and added more to it today on the pullback. So we're just above a minimum position size there on the MoFo and the Macro Pro re-rank product. So just want to call that one out. Again, that'd be currently our preferred exposure would be K-Web or through Taiwan. Again, that's EWT on the ETF side, and looking for kind of the low in the risk range and waiting for that oversold, and something like a KBA, which is more the the Shanghai composite index. And same thing with on the short list would be Singapore and Hong Kong. So just want to kind of reiterate that. Coach talked about that on the macro show today. So if you want to get a little bit more details, go watch that. I'm not going to rehash what he said, but basically that's certainly the SS&C signal that we get in the risk range is confirming that. And I think that would be, just want to call out China.
Not industrial China though, right? Or am I wrong?
No. Yeah. This is a good point. Yeah, good call, Arthur. So something we haven't talked about on here in a while. This is something that we had in the playbook, or we definitely reviewed in the past. But I was actually speaking to Mitchell about it yesterday on another subject, and he was talking about China, and I was like, "Have you or can you invest in CHIQ?" So that would be the consumer, Chinese consumer. That's consumer discretionary. So a great way to play that kind of quad 1, quad 2 environment. Discretionary is typically a great exposure there, and what Felix is seeing from his data, and certainly what when I sat down with him 2 weeks ago, I guess it was maybe 3 weeks ago now on Sector Head Spotlight. Most of his longs are playing this kind of COVID reopening, the consumer wanting to go spend money, and similarly when we had that same environment, what was that, in 2021, the consumer discretion was certainly where we, if you can remember back then, it wasn't doom and gloom and bear porn. It was, horny bulls and getting after the green. So we had that consumer discretion was a great way. XLY, right? Amazon, Tesla, the rest of the retail environment, XRT, those all really worked really, really well for us. And so if you can, it doesn't trade. It's not a huge volume CHIQ out of the Global X. So that's China consumer discretionary, but that would be something that you can take a look at. It's not something that we're currently long in any of our exposures, but just wanted to call that out in terms of CHIQ. Good job, Arthur.
Just
not
on,
the industrial. Yeah, go
just
ahead.
on that, I can't trade them, but the CHI. So if you go on TradingView and just put in the search box CHI, and then scroll down a bit until you see the little ticker with the green box and the orange X, you get the equivalent of all the kind of sectors. So you get CHIQ, CHIR, CHIX. So you have energy, financials, everything we need. So you've got all the different China sectors as well.
Yeah, so like tech would be CHIK, right? So yeah, exactly. Yeah, man. No, good call out. Yeah, so TradingView again. It's put on by Global. I think it's just Global X is CHIQ ETF. You can just go to their website or just Google CHIQ. It'll come up. It's not Crane shares. Global X ETFs. Yeah, they've got a bunch of really pretty high quality China ones. So go take a look at those. John, you jumped
Hey,
up.
Rob,
how
you guys doing? Great to talk to you for a
well.
second here. Hey, and Brian, the Muni dude, isn't on today, so I thought I would just chime in with a quick little Muni update. And remember, I work with family office, so I'm way more trend and tail duration investing than I am a lot of what we talk about here. So I am usually silent, but I'll tell you what. Short-term Muni rates have kind of been an issue. I know Brian's talked about this thing called SIFMA, which is like an overnight rate. And it's also the rate upon which leverage gets repriced for levered Muni product. And so a lot of income investors like to get some levered Muni exposure, because why not get more of a tax-free income stream if you're well-to-do, right? So the SIFMA had spiked up to a high of 435 2 weeks ago. It backed off last week. It was down almost 9% to 397, and it always resets on Wednesdays. So it reset again today, and it was down over 23% on its yield from where it was last week, and so therefore it's down over 30% from its high. So that's just a sign that that Muni pricing is starting to get at least the cost of the leverage. The cost is going to be coming down slightly. Probably it'll spike up again if the Fed raises rates again in May, but it may make it. We may be getting to a point where doing Muni investing with some leverage in it will be a little more appealing. And to that point, and Brian often will refer to these funds out there that are that have the potential for leverage, but maybe have none now. You might do some screens for those types of investments because you can get approximately 4.5% tax-free. And when some of these investment vehicles are able to put the leverage on, that meaning that they can borrow at a rate cheaper than what their longer dated munis are that they purchase, then we can see some enhanced yields there. So that's been something I've been positioning for my clients, and just, it's just being patient. I might as well get paid about what T-bills are paying, but get that in a tax-free form, knowing that likely those dividends are going to get increased in the future. And just a note on munis, I don't know if Brian's gone into this before, but the muni yield curve, at least the AAA curve, has actually been inverted on kind of the shorter end, and that has been coming down. So we see sort of a normalization. We're not there yet. We're still inverted, and I don't know that the muni curve has ever been inverted as long as it has been of late. But even just comparing it to a month ago, not only have rates gone down, therefore prices of muni bonds going up, but the curve is somewhat normalizing. It's still a bit inverted. You're pretty much just eyeballing it. You got to go out about 12 years to get the same yield that you would get kind of overnight or within the 1 year space. So anyway, that's moving. And maybe just a little bit of color, since I kind of run money for very wealthy families. I take a very conservative approach, and I don't do any active shorting. But I'm hiding out in basically 58% of my clients' money sitting in risk-free. I'm either rolling T-bills, or there's even some money market in there, and about 10% in gold, and split between gold and the US dollar, and about 12% in inverse strategies. So basically taking shorts. I don't actively short, but I'll buy an inverse product for my clients. So it's a long only portfolio that I run, but I'll do some of that kind of fun stuff. But I'm starting to add to some yield products. So about 18% of the portfolios now are, I'm comfortable buying some things that are yielding, pretty attractive yields. Everything from these munis we talked about to some other strategies, some of the things that Simplify Funds run and whatnot. So anyway, I just thought I'd give you my 10 cents there, and I have 80 basis points in long stock. So not going long yet on anything.
So you're really gearing up for a bull run.
Hell no.
Quad 2.
Hell no. It's that inverse product's probably going to get a lot more robust. Now, you guys, if you're actively shorting and following the process, you're going to do better than I'm going to do for my clients. But I gotta take a very careful approach in what I do.
Yeah, no, 100%. And John, I don't know if you had a chance to listen to the Sector and Friend or the Hedgeye and Friends from last Thursday night with Brian, Muni guy, who I'm now affectionately rebranding the Muni King. And that is for anybody who's listening in and wants to get a little bit more of an education on muni bonds. I sat down with him and we had a really good conversation. I didn't talk a whole lot, and probably a good thing because I was on the train and I think my audio was kind of shit. But but Brian did an absolutely phenomenal job of walking folks through just general. Might have been a little basic for you, John, but I thought it was really, really high quality in terms of just getting people a bit more of an exposure or kind of an introduction to how muni bonds can fit into one's portfolio, and sort of how to look and evaluate different deals and incorporate tax strategies within say your own state, and kind of start there and then kind of farm it out to broader components. It's up across our Hedgeye podcast channels and YouTube as well. So if you are looking for it, go check that out. It's a great conversation.
Yeah, absolutely. Brian is a true heavyweight, and the best thing is he isn't selling anything. So he's giving away key information without having a product that he's really just trying to wrench a bunch of fees out of you for. I mean, there's like nobody like him out there, quite frankly. So, and he shared with me the agenda that he was going to run through. I wasn't able to be on it. Believe it or not, I took a pilgrimage with my 5 youngest daughters from North Idaho down to Southern California for a Stray Kids K-pop concert. If anyone wants to do some good Lenten penance, take 5 daughters to a K-pop concert many states away on the road during spring break. You'll have a great time. So I haven't had a chance to hear it. I am going to listen, I promise. But it looked like what he covered was going to be awesome. So I'm sure it was great. Thank you.
Yeah, no, absolutely. No, appreciate you jumping up, John. Thank you very much. All right. Well, other side, Chris, I'll throw it back to you guys. Anything you want to kind of wrap up with? We got almost an hour and a half here on the docket. I think we covered everything. I certainly
Around my daughter's gymnastics, pecking away at my notebook, and I'm here till 8. So no, you guys covered a hell of a lot, and I appreciate it. Thank you very much.
Yeah. No worries. Moyer, Thousandaire FX.
I feel like I need to do the whole Jimmy thing and talk about crypto. No.
Wait, it was literally the one thing I was like, oh, you know what? I didn't talk about Bitcoin. Maybe I should, but I don't know. I mean,
What
Jimmy.
about LiDAR? You can talk about LiDAR.
Yeah, Jimmy runs money. Shout out to our boy Jimmy. We're not gonna talk about LiDAR, but Bitcoin. We can finish off with Bitcoin. Everybody loves Bitcoin. And Chris, you love trading crypto and quad too. So yeah, why don't you just keep running with it, Chris?
No.
No.
There's actually been some quite big moves today. There's like some of them are up 6, 7, 8% today. It's so much like I've joked in the past, right? Everyone is so quick to kind of put these big, huge, like big IQ, big deep thinking thoughts about what everyone is doing. And I've joked in the past, it's like, what if someone at JP Morgan just got told, right, by Monday you have to have a crypto trading program running, and he just listed all of the normal kind of whatever the lowest vol would be at the top, like whatever short-term rates, although not for the last month, but short-term rates, that's low vol, so let's just put that in the next to Bitcoin in the in the spreadsheet, and then whatever's like the 100th most volatile thing, put that next to whatever some random shitcoin, because it looks just exactly like FX. It's like Bitcoin's kind of not really doing anything, which is what the dollar's doing, and then everything underneath it is this like really big moves if you go down and have a look. I'm not saying you should go and buy any of it, but if you're a trader, there's still loads of stuff going on, and if you trust any of the exchanges. But yeah, I found one cropped up on my dashboard earlier today. I don't know which one it was now. It was up like 17% today. God knows why, but it's only up 10. It's only up 10% now. So.
Yeah, I got nothing really to say other than trend is 31,556. Keith gave that out this morning. He gave you certainly his opinion or our opinion this AM on the macro show. It would be a fade, this move to lower highs, and yeah, that's about it. So I'll just leave it at that. But yeah, I mean, listen, if you want to trade around it and that's your prerogative, then by all means. But I'll just leave it for. I'll see it at 16,000. I'm just going to say it. I'll see it at 16,000.
Obviously, you've got to buy Dogecoin because Elon changed the symbol on Twitter, right?
Yeah, he did.
That's bullish.
Yes, Doge. I wonder how many folks actually bought it post that move, being like, "Oh my God, Doge." Anyway, all right, we're getting off topic.
Yeah.
Let's wrap this wrap this bad boy up. I almost dropped the F-bomb there. I didn't mean to do that. So again, thank you very much, everyone, for speaking, for contributing on this evening's or late afternoon's conversation, weekly notebook review. We'll be back next week, same time, same place, 4:30 here on Spaces Live. You can catch it on all of our podcast channels, Hedgeye, et cetera, et cetera. If you're looking on the podcast side, just go. We kind of changed things up recently in the last 2 weeks. All podcasts, everything that's produced, whether it's Ami Joseph and Unscripted Equity Curiosity, which is Ami Joseph, our sector head of technology, Andrew Friedman, our sector head of communications, and Felix Wang, our sector head of China. Those three have a podcast. All of the stuff that I kind of lead And then everything else that we do in here at Hedgeye, from free webcasts, et cetera, like the mother of all bubbles that happened on part 2 was Monday. Part 1 was about a week and a half ago. Those are all now just on the main Hedgeye podcast channels, on Spotify, Apple, wherever you wish to consume. So just go subscribe and like and what have you, follow whatever it is, and those will hit your inbox. We got Sector Head Spotlight, as I said, with Jay Van Skyver tomorrow. There'll be no beginner's guide on Friday, as it's a holiday. We'll be back on that next week. So looking forward to seeing everybody tomorrow at Sector Head Spotlight. And thanks again for a great week. Keep grinding out there, and remember, get short and get paid. Cheers.